This one's going to be fun. I like this question. Let's compare an investment in Optifuel to an AI investment, which is all the rage right now, and to a hydrogen mobility investment, which was the highly favored decarbonization investment until late last year. Comparing to AI investments. AI investments are attractive because they allow a small investment in intangible assets to generate recurring revenue through subscription models. The model is simple. High potential reward for relatively little cash, with the understanding that many investments must be made, and one win drives overall success. What are the limitations? The AI space is characterized by rapid innovation, extreme volatility, and intense competition. I mean, just last month in January, when Chinese AI company DeepSeek released technology that rivaled ChatGPT using less sophisticated chips and at a fraction of the development cost, it wiped billions off chipmaker Nvidia's market cap overnight. In the AI arena, hundreds of competitors exist, and technology can be quickly superseded by cheaper, faster, or better solutions, creating significant competitive and product risks. In contrast, the locomotive industry is characterized by incredibly slow innovation, long product life, stable and predictable demand, and virtually no competition. Moreover, the industry unit economics are far superior. The average customer relationship in rail spans nearly a century, with railroads replacing 3% of their fleets annually. That translates to over $1 billion in orders every single year from just one Class 1 railroad. In addition, the industry benefits from multiple monetization strategies for high-margin recurring revenue, including long-term fuel contracts, leases, software and data services, and maintenance and warranty services. So while Optifuel does require some physical overhead and tangible assets, our modular engineering and strategic approach make us remarkably capital efficient. And our development costs are actually more efficient than a single version of ChatGPT. For context, ChatGPT 4, which launched in March of 2023, cost somewhere between $41 million and $78 million to develop, and it's expected to have a product life of approximately 2 years before being replaced by ChatGPT 5. By comparison, for a similar capital investment, Optifuel has developed a highly differentiated product designed to last 50 to 100 years before it risks being replaced by the next best thing. So while AI investments may appear enticing, Optifuel offers similar return potential with significantly less risk, a much more stable industry, and very compelling long-term investment opportunity. Now let's compare Optifuel to hydrogen investments. Over the past 3 to 5 years, billions have been invested in hydrogen mobility projects, from infrastructure and production to hydrogen-powered vehicles. Yet last year, we witnessed the collapse of these projects. Nikola Motors, which developed hydrogen-powered semi-trucks, filed for bankruptcy, while stocks for companies like Plug Power and Ballard tumbled. Major energy players, British Petroleum, Shell, Equinor, scrapped multiple hydrogen projects. And even venture-backed companies like Universal Hydrogen that were so hot to trot, they were set up for failure from the start. While hydrogen benefited from political and regulatory support as a decarbonization option, it struggled with fundamental issues: insufficient availability, high production costs, and inefficient storage and transport. Hydrogen requires significantly more storage space than diesel. So for applications that either don't require much fuel, have ample space for fuel storage, or could be refueled quickly, such as in rail yard operations, hydrogen can work. For example, Optifuel, we built power and fuel storage modules for Sierra Northern Railway's hydrogen-powered locomotive, where the operational constraints are different because the locomotives operate in a yard and have access to a dedicated fuel supply. However, these same benefits don't translate to line haul operations, where the average train travels over 1,000 miles between fuel stops. In that scenario, a hydrogen-powered locomotive would need to carry 8 to 10 tanker cars of hydrogen per trip, a dangerous, cumbersome, and prohibitively expensive proposition. So the fundamental issue with many sustainability investments is that the economics simply haven't added up, and fundamental deficiencies led to significant but predictable failures. Sustainability, efficiency, and profitability can't be mutually exclusive. And this is exactly where Optifuel's approach stands out. Optifuel delivers deep decarbonization impact with zero emission and near zero emission locomotives. Our highly differentiated product meets a market with tremendous demand, an urgent need for modernization, minimal competition, and a significant first mover advantage, all while offering highly compelling prospective returns. So while investments in AI and hydrogen are fraught with intense competition, rapid tech turnover, and often unproven business models, Optifuel offers a unique value proposition. We combine the stability and longevity of a 200-year-old industry with breakthrough, adaptable technology and economic viability. Our diversified revenue streams and strategic market positioning provide compelling, risk-adjusted returns that few other investments can match.